Okay. Start whenever you're ready.
All right. So I'll start by kind of introducing myself, and Brandon kind of gave a little bit of background. So my name is Brett Samaha. I work actually for Brandon at AIG. I've been at AIG for a little under 10 years. As I alluded to, kind of did not study actuarial science in college. I kind of somebody said, oh, there's these really hard exams, and I know you think you're good at math, so why don't you try it? So I took a couple, and I passed a couple. So then I kept going, and then applied for a job at AIG, which was right down the road from me. And somehow they hired me. So that was about 10 years ago. I was in the group benefits portion of AIG at the time. And then in that time, most companies have some sort of a sponsorship for studying, and they'll pay for exams. So AIG's been good to me. So that now I became a fellow of the Society of Actuaries in 2018. So maybe 2 or 3 years ago now. As some of you may have heard, I was kind of helping my family out in the farming business prior to this. And I did some other odd types of work. So that's a little bit about me. So would it make sense for everyone to introduce themselves, or I've got a couple of slides we can go through after that, just to kind of get the conversation started?
I can start. Everyone knows I'm Ty McAllister. I'm the communications manager of the department. And this is the type of things that we do. I put on events like this, recruitment, retention. I typically serve a lot of our undergraduate students, but I will tap into some graduate student opportunities as well. James, looks like you're next.
I am James West. Yes, I am an instructor in the math department, as well as being Ty's assistant for this pursuit. And, but no, really, I'm the co-director for the program. And that's why I'm here. And, but I'm also generally interested in, I mean, in general, the AIG talks are always really nice. And I think that you guys are awesome for coming and doing this and being a part of our program. And we really appreciate it. The end.
I can go next if quick. If I think I introduced myself last time, but I work at AIG. Have been at AIG for, maybe I didn't do a lot of background. So I went to undergrad at Morehouse College in Atlanta. Started out a math and engineering dual degree major. Wanted to be an engineer. I had my first internship in engineering and decided that I didn't want to be an engineer. And so I just decided to finish my math degree without an idea of what I would do with a math degree. I thought it would be cool to be a teacher, but I also understood that teachers don't get paid a lot of money. And so I decided against doing that. And so I think in my last month of my senior year in college, I decided to look into actuarial science. I think I heard somebody talking about actuarial science in one of my senior math classes and just decided to look into it. Found out that Georgia State, which is also in Atlanta, Georgia, had an actuarial science master's degree program. I applied for that. Similarly, at the same time, Georgia State was introducing a new minority scholarship program where you get a scholarship to Georgia State, an internship at New York Life Insurance Company, and then your tuition was paid for, exam reimbursement and that kind of thing. So I applied for that. got into Georgia State and did a master's degree in actuarial science at Georgia State. After Georgia State, I'd had the summer in between my 2 years at Georgia State. I had an internship at AIG, and then came back to work there full time right out of school. Stayed at AIG for a while through the bulk of my exam work. Decided I wanted to just try another company or another type of work to see what that looked like. So I decided to go into consulting. I went and worked for Ernst & Young as an actuarial consultant for 3 years, and then was exhausted with the pace of consulting and decided to come back to work in industry. And now here I am back at AIG. So that's the story. I think I forgot to tell that last time I was on.
Should we go in alphabetical order? That would get us to
Yeah.
Clark.
Yep, I'm just about to pick somebody. I'm going down the line.
Hi, I'm Clark. I'm about to start my senior year at U of H. I'm a mathematics major. I also started out in engineering. I got into that and I realized I didn't like that, so I took some time off school and came back as a math major. And Fabrizio there talked me into taking a probability class with him. So I took it and realized I really like probability, and so I figured I'd look for a career path where I'd be doing that kind of stuff. And so I'm at this camp to give a try being an actuary.
Fabrizio, you're next.
Sorry, my bad. I thought Chris would be next. My name is Fabrizio Pacheco. I'm also a math major here. And I'm going into my senior year. I've been a math major basically for all of my college career. And it's been really enjoyable. And I remember it's funny because even Clark, he came in as an engineer major, but even though sometimes I'm still taking some notes from him, so it's it's really funny. But yeah, I apologize. I wasn't able to make it the first one. I had a bit of a emergency, but yeah, I'm just here for my senior year, and I'm really excited for it, for probability. So yeah.
Patrice, you want to go?
Hi, my name is Patrice. I have been teaching for quite some time now, for about 7 years. Before that, I did my undergrad in mathematics as well as my master's in mathematics, and not sure of what to do with it as well. And I know there was like an oyster of out there like doing anything with math, but not having really sure what I wanted to do. I went into teaching. Not right after my grad degree, I did some work with NASA, doing an internship with them. That's how it brought me out here into Houston. And then I just decided to stay. But now I'm at the point in my life where I want to do a career change, and I'm making that move.
Looks like Michael, you're next. This is weird. It's not alphabetical.
Hi.
I'm sorry, it's not alphabetical. I'm going down the list. I'm like, wait a minute, it's not alphabetical.
I'm Michael Delicassi. I got my undergrad in economics about 10 years ago, and I've been doing sort of odd jobs and then stay-at-home dad for the bulk of that time. And so just recently I've been trying to figure out what I'm going to do as I transition out of being a stay-at-home dad, as the kids get all in school and everything. And I've come across the idea of pursuing an actuarial career several times sort of along the way. And so I started looking for resources to see, how prepared I am for doing that type of thing. That's when I found the camp. And so that's where I'm at and what I'm figuring out.
Okay, it shows Sana next and then Christy you're last somehow. I don't know.
Hi, my name's Sana. I'm a math major. I've also been a math major pretty much since I started U of H, but I kind of went into it not really knowing what I wanted to do. But all I knew was that I really liked AP Stats in high school. So I started looking into what careers use probability and things like that. And I found actuarial sciences, and it seemed really cool.
You're muted, Christy.
Mute button.
Hi.
Hi.
I have been out of school for a few years, but I work as an admin for a real estate development company here in Houston. And I have some background in biostatistics from Tulane that I liked as far as, you know, the probability and the statistics of it. So this is my first introduction to actuarial science and the probability test. I'm just seeing if it's something that I enjoy.
Fantastic. Was that everyone, or did we miss someone?
I believe that's everyone. Other than if you want to know about the instructors, you can. Muhammad and Greg.
Well, if they feel like speaking up.
They're mute. I guess we can start.
Yeah, I'll just comment like that. It seems like a wide breadth of experiences we have here. So, I mean, I think I heard people that have been teaching or out of school for 10 years and people that are in school, right? So I think that's exciting, and I can certainly relate to being out of school for 10 years and trying to take exams and stuff, and the economics degree. So I was going to go through a couple slides, mostly about, you know, the basics of life insurance, since that's the business I'm in at AIG. But kind of hoping it spawns a discussion, because I don't know if you're like me, you know, watching some guy drone on about slides is like not the most interesting thing in the world. So you know, maybe it'll spark something of interest that you want to talk about. So I wasn't really going to give exam tips and tricks, so I hope that's not a deal breaker. I will say I do write questions for the society, for not the exam P though. So I don't know what that's worth. All right, so I'll share my screen here, and host has disabled participant screen sharing. Is that something that's we can undo?
Yes, hold on 1 second. Make you co-host.
Oh, nice.
Yes. And Brandon to, wait, who did I just give co-host to? Yeah, okay, I gave it to you. Hold on. Brandon, co-host. Yes.
Oh, so I'm clicking on the chat and not the screen share. So I will share this application. Can you all see my screen here? Or no?
Not yet.
Not yet.
No.
That's because I didn't click. You have to click something like 3 times, apparently.
Yes, we can see it.
Okay, I apologize for that. Okay, so just going to talk about life insurance again. So if if you have any questions, or even if you think it's a completely unrelated question, career advice, I'm seeing this more as free form rather than like getting through these slides as the goal here. Okay, so life insurance can be kind of like not, when you take a step back and think about it, it's kind of a morbid type of a business. So we got some clever quotes here. Getting life insurance is like making a bet you can't win. So, so I personally own or have bought a couple life insurance policies because I have some children that I'd like to be able to have a life if something bad happens to me. So, so it's really important. I think it kind of, it takes from a societal perspective, when very tragic situations arise, it kind of mitigates that as much as money can do. And it also has a lot of other purposes. So take a second and look at some of these other cute quotes here. Salesmen usually aren't the most popular people, particularly when they're telling you that you're going to die. And then this one kind of gets at the law of large numbers and the probability that you guys are studying for and applying for exam P. So yeah, one person, it could be tomorrow, it could be 100 years from now when they pass away. But if you group together 1 million people, you can come up with a pretty accurate model for how those lives are going to evolve. So, so I'll just jump ahead then. So, a little overview of the whole life insurance industry. Pretty big industry. $145 billion of premium. So that's like policyholders giving money to an insurance company in 2019. And that's just life insurance. So if you take, like, if you broaden the scope out, there's what I described, life insurance that kind of is a bet that you're going to die. That's the strict sense of life insurance, but there's ancillary products for savings, annuities, for example, or health insurance. So that makes the pie a lot bigger. 680 billion if you're looking for a big number to throw around. So according to this statistic that we found, 60% of people in the United States were covered by some type of life insurance. I guess that was as of 2018. I actually find that a little on the high side, but when you think about it, that means 40% is not covered by life insurance. So yeah, maybe those 40% are millionaires and their family is going to be just fine without life insurance, or more likely they're probably in some sort of underserved market, or maybe they're in college, or so. Just kind of an interesting factoid that you could do what you want with. Who are the big companies? Over here on the right, MetLife is the biggest. Looks like they got a 13% market share. Prudential is another big one. AIG looks like is coming in at number 8 as of this ranking date. But then there's probably hundreds of smaller companies. So those are 3 big companies traded, on the public stock market. There's there's also lots of small mutual companies that are essentially owned by the policyholders. On this list, there's New York Life Insurance Group, which is one of those mutual companies. So I don't know, any questions on any of this? Just kind of getting our feet wet on some of the facts here.
So Brett, maybe one comment that I'd add on this slide that maybe to tie it into current events a little bit. So I think, the area that you and I work in, we deal a lot with kind of setting up our financial forecasts and our projections for future sales and of life insurance, for example. One thing that's interesting in the last year and a half with the COVID pandemic, I've seen a lot of surveys that would suggest that because of the COVID pandemic and the fact that that COVID kind of brought the concept that we all might die one day to the front of people's minds. I've seen a lot of surveys that said more people now are interested in purchasing life insurance, and so that's kind of one of the types of considerations that we tend to think about as we're coming up with our estimates and our assumptions that we use in our projections. So interesting kind of current events tie into this slide.
Yeah. It reminds me, there's like an old adage that maybe the tide is turning, that life insurance is, I hope I don't get this wrong, it's sold, not bought, meaning that, some guy's got to come pounding on your door or call you before you buy it. But with COVID and unfortunately the in-your-face nature of our own mortality, maybe it's becoming bought and not sold as much.
Just out of curiosity, if I may ask, because of COVID, have you been getting more people signing up for life insurance like more than ever during the past, sorry about that, but during the past year or so, have you getting more people wanting to buy life insurance, or that's not the case?
I don't have those statistics right off the tip of my my tongue. Recently, so a couple things. We had to restrict our underwriting, which is who we're going to sell a policy to, at the onset of the pandemic. So unfortunately, we won't be able to survive long if we're selling policies to people that are have a terminal disease, or at the beginning of the pandemic, we didn't know. The numbers are still kind of moving around. So just to kind of protect ourselves, I think we made our criteria that we look at before we'll sell a policy a little tighter. So so that by its very nature kind of restricted how much we sold. And as of now, I don't really even know how much I'm allowed to talk about it. I would say sales have kind of returned to maybe pre-pandemic levels. So I would not classify it as a spike in sales, but I'm trying to give you a sense that there's some moving pieces. One, we are making it a little bit harder to buy a policy just to protect ourselves from that concept that we call anti-selection. And maybe what's offsetting that is a higher demand. So there's kind of two competing forces. I don't know, Brandon, would you disagree?
Can I follow up and ask a question about this topic? So I imagine a lot of that, especially the freeze at the beginning of the pandemic, was, you've got this rush of new information that no one knows anything about, and your models are all built on having information, just like your first slide said, of having that information of how thousands of lives behave over on average versus individuals, right? And maybe you can't talk too much about this, but I was just wondering, how something that has a higher than you would want, but on a societal level, we're not talking Spanish flu level of deaths here, right? Like obviously something like that would be catastrophic when it comes to paying out life insurance, I would think. Something that has a death rate is, reasonable, for lack of a better word, as COVID or something like that. Like how fine are your margins where does that make, could that be, like a business killer, I guess, is maybe where my questions are. In the wiggle room perspective from, while we're being morbid.
I'll give it a shot, Brandon. Like if I start saying confidential stuff, tell me shut up or something. So it moved the needle, and we report this publicly. So our lifeline of business, prior to the pandemic, was making profits. So we're taking in more premium than what we're paying out, and then during the pandemic, which we're still in.
I imagine that's the plan, by the way.
Yes, that is the plan. So it went from profit to loss, but not, as you mentioned, James, not catastrophically so. So our regulators, they want us to have enough money sitting around that even in a 1 in 200 or 1 in 500 year mortality scenario, we can cover it and remain well capitalized. It didn't even, or it hasn't yet come close to that. So I don't know if that helped. So we went from profit to loss, but not to the point where there's a solvency or business killing.
Right.
So Brandon, go
So
ahead.
one thing to keep in mind, like life insurance is a long game, right? Like it's a many year proposition. And so we can have losses in a quarter, but like Brett said, we're required to set aside money so that we can pay our claims out until the end of the last expected life of the last person that we insure. And so again, like we have enough money set aside to pay our claims, far into the future. However, because of the way that accounting works and because of the way that the claims came in and the premiums came in over the last year and some change, we did actually report losses for the past, 4 or 5 quarters or something like that. But I think maybe to tie back to the question that Fabrizio asked, I think the question that you asked is actually a question that we're asking ourselves now. Kind of, are we seeing, now that the pandemic is starting to lift, now that we know that people's attitudes are changing about life insurance, or we suspect they are we seeing that level of sales kind of come back, and and will we see it to continue to come back and grow going forward? So that's the type of question that we pose to ourselves and that we struggle to try to figure out and to build models around, just on an ongoing basis. So I don't think we have the answer to, if our sales have rebounded and increased above pre-pandemic levels yet, but it's certainly something that we're watching pretty closely. So.
I imagine that's something of a double-edged sword, though, as well, right? Like, because you're kind of cutting off sales at the very time when everyone wants to buy from you, which is not typically what you would want in the business of selling things, I would imagine.
Yeah, so certainly competing priorities, and it was, those were decisions that we struggled with, and we met on regularly and discussed.
I imagine that's why you need actuaries in part, right? I mean,
yes, yeah. No, I mean, we attend some of those meetings where the decisions about, like our underwriting guidelines or decreasing underwriting or increasing sales, those types of decisions are made. And so, fortunately, we have since, kind of loosened our underwriting guidelines and kind of gone back to our pre-pandemic, just recently, like within the last couple of weeks, gone back to our pre-pandemic underwriting criteria. So we'll look to see if sales rebound to where they were.
I'll just note, as like the conservative actuary at the company, we got to worry in two scenarios. If we're not selling anything, we get worried. And then if we're selling too much of something, we got to be worried because maybe people know something we don't know. So there's like a fine line of sales that we need to straddle. Is that the right word?
So just one last thing that I'll say, this would have been a great discussion to have Doug Weatherwax on, who's the other person that was supposed to be joining us. He's in a meeting now, but he said he will try to join afterwards. And so if he joins, it would be a good thing to discuss again with him, because Doug's specialty really is studying our mortality and our underwriting. So he leads the data analytics focused team that really just kind of zeroes in on this type of question, like what is the data showing us about about COVID and its impact on the insureds that we're getting in the door and that kind of thing. So just a note, if Doug happens to join, perhaps get his perspective about COVID and what's happening with that.
Absolutely, yeah. He's the expert at the company, so feel free to ask that question again if and when he joins. All right, any other questions before I throw more information at you guys? All right, I will continue. So a little bit about just AIG. Stands for American International Group. I think it was founded 102 years ago, maybe. So if you open up our website or our financial disclosures on the SEC website, we think about our business in two broad categories: the general insurance, also referred to as like property and casualty. So traditional property and casualty is auto, homeowners. AIG kind of plays in the commercial market more, rather than, so what I just described are the consumer market. The commercial market is like workers' comp, airports. We're currently in the cybersecurity insurance business. So that's probably what AIG is famous for, or most famous for. And then the second segment, which is the segment Brandon and I and Doug work in, is the life and retirement. So that's annuities and life insurance. So if you judge it by revenue, as you can kind of see in this pie chart on the lower right, by revenue, the general insurance is 64% of so you can call that 2/3 if you give me a little leniency, and 1/3 of the revenue comes from the life and retirement. If you look at profits, it might be closer to 50-50. So I like to make the life and retirement area look good. So I'll look at the profits, and other people can look at the revenue. Can't have an actuarial discussion without looking at some numbers. So assets, which is like the things we own, and some of them are physical things you can touch that we own, and some are not things you can touch, which maybe we'll get into in a future slide. 577 billion. So I forget what Jeff Bezos clocked in at, but what is that? 5 Jeff Bezos's investments. So that's like bonds or stocks that we own. So those are a type of asset. So 350 billion of that 577 is investments. So then kind of moving down on the, so I don't know how familiar you all are with accounting, and this is not an accounting class. So those are like the things AIG owns, and then there's the things that we owe other people or liabilities. So showing them as the general insurance reserves, which is we collected money on people's auto policies, and we haven't paid out the auto claims yet. To keep it simple, we have 71 billion of reserves there. And on the life and retirement side, since that's more of a, I would say, an asset or investment intensive business, there's a lot more liabilities and reserves, 290 billion. So a lot of that is like of a bank account type liability. So if you only gave me one sentence to describe the insurance business, other than complicated, it would be, we take money today, we invest it, and we pay for future obligations in the future. I said future twice, but that's the simple explanation of insurance there. So I don't know, any questions about AIG? And
I know it might be a little bit of a loaded question, and you kind of like answered a little bit, but like I guess like whenever someone's like coming in to like you guys and they want to make a life insurance plan, do they give you like a list of information, or they come with, and you kind of evaluate that and like make an insurance plan for them, or is there already like life insurance plans you have set, and like how does that kind of like go about?
That's a great question. So I'm going to interpret it as like, first of all, I'm not the sales guy, but I've been on the victim of them. So so we sell, a portfolio of products, and there's different ways we sell them. So a term policy, which is what simple people like me own, I kind of called up a broker, or AIG Direct, probably in my case. They basically ask how much life insurance do you want? How long do you want to pay for it? And it's because I have a mortgage, so I wanted 20 years of insurance. So that was more like, I tell this guy what I want. Because term insurance is pretty simple. So it's sold in like these, less interactive ways for the most part, because there's not as much, they're trying to make it seamless to sell. So then, like the more savings or tax friendly savings types of insurance, those are kind of sold through financial planners or estate planners, and yeah, they'll want to know, okay, so you've got 2 kids, they're 5 years old and 3 years old, and you want them to go to college, and then you want to give money to your foundation when you're 80, and then you want your grandkids to have college funds. So they'll work out all of your goals. These are problems I don't have, by the way, and come up with some sort of an insurance plan to like minimize taxes and kind of just optimize your whole financial picture. So I hope that helps.
Hold like multiple meetings and kind of, I don't want to say like multiple conversations about that kind of their background, like in sense, and then eventually you try to come up with what fits best for they kind of give feedback of like what fits best for their life, or what they want, or some legacy, or for their kids and such.
I have a sample size of one when someone was trying to sell this to me. So it was multiple meetings. So it was like, one, tell me all of your information. So then I have to go pull it together. send him like my financial information. Then he goes and puts it into some magic, black box that spits out recommendations. And then we talk about it. And then I say, well, I don't want to retire when I'm 65. I want to retire when I'm 40. So then how much will I have? So yeah, it's iterative in that way. So I think I answered your question. That's a great question, Fabrizio.
Yeah, I would just always wonder like how it's gone about.
Maybe an comment to add on to that. So in this age where everything is done digitally and online, and folks are kind of getting used to, like, you order your food on an app and it comes to you in 30 minutes or so, life insurance companies are considering new digital ways to sell business. This is another kind of area where Doug Weatherwax is involved in automating our underwriting strategy, because when you apply for a life insurance policy today, especially if it's over a certain amount of coverage, there's a certain amount of data that we have to collect from you, which includes, in some cases, like blood samples to determine how healthy you are, a lot of information from your medical records and that kind of thing. The life insurance industry as a whole is trying to develop ways to automate that process and make it a more seamless process so that you can go online and buy a life insurance policy to kind of cater to the younger population, because you're just not in the habit of spending months and months to try to purchase something that you need for yourself. So good question again.
Yeah, I know my generation definitely would just want to go online and just sign up for it real quick. So yeah, I could get that. Yeah.
And that triggered a response to the earlier question. Like, are we seeing sales ramp up? So part of the thing that makes the data hard to look at, Brandon mentioned, we send a phlebotomist to your house to collect blood in many cases, and people don't want a person coming to their house to collect blood in this pandemic. So there's a lot of cross currents to answer that question you asked earlier. I think it was Fabrizio. So good conversation so far. So I will power through, but please stop me. There's just like some terminology that general insurance or life insurance terminology. So if we talk about premium, that's the money that someone buying a life insurance policy pays to the company. So that should cover the benefits, the expenses, and some profit in a perfect world. Then we talk when we say benefits, what it's the dollars paid from the insurance company to the insured. I'm trying to just read the slide here. Most of the time, the insured event in life insurance is a death, but that's not always the case. So, but let's just say the insured, for simplicity, if the event is death, the benefit is, we give you, if it's $1 million policy, $1 million once we have evidence that an insured event occurred. We'll talk about reserves. So it would not be responsible for us to just take in premium that you give us and go and, I don't know, give it to our CEO so he can buy a house in Miami. Most of it is going to be for a future claim. So we need to set up these reserves, which is the money set aside to pay future claims. So hopefully that makes sense. Valuation is the exercise of the calculation of policy values. So one of the most important is the reserves. So that gets reported on the balance sheet, which is the assets and liabilities I kind of alluded to earlier. So the process of performing valuation is performed often by actuaries. So that's a very big part of what actuaries do. You know, pricing is another big part. I won't get too in. You guys got to stop me. I can go off script real quick. Life insurance policy is there's a legal contract that occurs when you buy one of these things called the life insurance policy. So it's the contract between a person and a life insurance company. So usually pretty long because for a number of reasons, which I'm not qualified to get into for the most part. Policy issue date is when the insurance begins, and just a product. So as I've alluded to earlier, you know, we sell, you know, term insurance. You can have health insurance, whole life. I think one of the future slides kind of gets into this. So I don't know, any other terminology that you guys may have heard that maybe I can provide some insight into, or okay. So there's some characteristics of a particular life insurance product that I alluded to on the previous slide. So in the term world, which is probably, at least when I think of insurance, it's like the most pure type of insurance. You pay premium. It's not very much premium in the scheme of things. And you get a sizable amount of death benefit if unfortunately a death occurs. So I'll give you my personal numbers. I think I bought a $1 million policy maybe 5 years ago. And it's a 20-year term length, and the price is $380 a year. So over the course of 20 years, I think I'm going to give AIG in my example like $7,000. And if something unplanned happens, I won't get $1 million, but you know, my kids can go to college, hopefully.
Since it's the company you work for, are you allowed to do that pre-tax? Can you have them just take it from your paycheck?
There is an option, which I did not elect, to have it taken from my paycheck, but I don't believe it is pre-tax. So you pay the premium with after-tax dollars, and the cool thing is, the benefit is not taxable. So
when you're talking about term life, and maybe you're going to get to some discussion of this, but can I ask about like in a basic sense, annuities, they're sort of like reverse term life insurance in a way, right? Like you essentially pay the payout up front, betting that I'll live longer than you think I will, in a sense.
That's exactly right. So life insurance, the policyholder pays a little bit while they're alive in exchange for a lump sum, you know, at the end. And annuities are kind of the reverse. You go to lump sum now in exchange for a trickle of money while you're alive. So it's interesting in some of the more involved calculations that happen. A company that has a good balance of annuities and life insurance, like the regulators kind of look favorably on that from a risk perspective, because again, this is going to sound morbid, you know, like a nuclear bomb drops on New York City or something. You know, what you pay out in death benefits, you're not paying out on your annuities or something. So it's never that clean, but there is some offset there. I don't know if that's what you were getting at, James.
No, that example's interesting, and I do have some questions in that direction later that are kind of related to that sort of a scenario.
Okay. Just finishing off this slide, I mentioned I have a 20-year term length policy, which is now 15. If you stop paying, your policy kind of ends. There's some contractual terminology to kind of make that go in the policyholder's favor. So you can't just end the coverage immediately. We have to give you like 60 days. My son might barge in here. Okay. So additional benefits. So I'll bring this back to my own personal policy. If I get diagnosed with terminal cancer and I get a doctor's note saying I have less than, I think, 2 years to live, that kicks in like a terminal illness rider. So I guess I can kind of collect my death benefit slightly before I die. So maybe I get to enjoy some of a hot air balloon ride or something. So term, the least expensive type of coverage, and it's probably the most useful for everyday people. And I would argue provides the most societal benefits. So I don't know, any questions on term?
Yeah, on the concept of the riders, like the terminal illness. So this is more of a theoretical, but like you have a 10-year term and you have 3 years left on it. If you were diagnosed with a terminal illness that you had, say, 7 years left to live, would you be able to take the rider then, or would that just be eliminated because it would you'd have more time than your policy?
It's a good question. I haven't read all of the types of riders. The ones I have read, like at 7 years would be, maybe I would argue you don't have a terminal illness if you have 7 years to live. It's usually 2 from my experience. So it's kind of binary in that sense. It's not like, well, if you have 10 years to live, we'll give you, I don't know, 10%. It's kind of, I don't know, Brandon, is that even accurate?
No, I think that's accurate. And I think what I would comment is just, again, another good question to lead to kind of some of the things that actuaries work on, right? And so the legal language that's in the contract is written by our lawyers, but there's a lot of negotiation when we offer these types of riders about what makes sense to offer, how much benefit are we going to offer, and how much risk are we as a company willing to take on. And so while Brett's rider might say 2 years, that was probably a decision that required input from actuaries that said, a terminal illness, we can expect that someone with 2 years left to live, we can price for the fact that they're diagnosed with 2 years of life left, and that goes into our actuarial calculation of the value of that rider, and we decide if we're willing to take on that risk. And so there probably is variation on riders if you go from company to company, I imagine, just in the language that's written in the contract. But it's going to be specifically spelled out before you purchase the rider. Like the language will say, in Brett's case, it will say 2 years, because that's what the company has agreed to, and that's what the language that we've gotten approved by our state regulators, et cetera. But all questions that, again, the actuaries are involved in those types of discussions.
I have a question on that. So if something like that is invoked, but then you die in a car accident on the way home from your trip to the doctor, is there a difference in the payout at that point? Like, I assume that would negate part of the original payout, even though it's not being, you see what I mean? Like the death is sort of from a different source, but maybe that doesn't matter at all once that's invoked.
So, I mean, your example's interesting. So if you exercise the rider, and we've paid you, that typically just ends the contract. So now the contract is over. But like maybe you didn't finish the paperwork and then you died in an accident. So since we're on the rider topic, often there's also like an accidental death rider. So if you die in an accident, that might like double the benefit. I think that's a common accidental death benefit rider. So you've asked an interesting legal question, but I think for that to be the case, like you couldn't have collected on the terminal illness portion of the rider. But you could have the makings of a good lawsuit there, which are not uncommon. Okay.
Thank you.
Yep. So that was on term. So whole life, to juxtapose. Then I'll just kind of mention after this term length, and if you live, kind of the contract's over, you paid a little bit of money and you didn't really get anything other than peace of mind, which is valuable. So it's pure insurance from that perspective. Juxtaposing that is whole life, where you're going to pay more, but it doesn't have that phenomenon where it comes to an end. You've got nothing to show for the money you've paid. It kind of builds. You pay more throughout the time period. It lasts your whole life, and there's a cash value that builds up, which you can kind of, if you need that money, it works partly like a bank account. So you can take a loan out on that cash value, or just surrender your policy and lose the death benefit, but get your cash value out. So the premiums would be orders of magnitude higher than term. So I think I said mine is like $350 a year. It would be thousands a year for $1 million whole life policy. I don't know, any questions on that? I'm starting to accelerate. I don't know. How much time am I supposed to talk for?
I think we allotted for an hour, but it just depends on how much more you have to go. I mean, you talk how you see fit. If you still have maybe 5 or 6 more slides you want to go through, because I'm sure the participants wouldn't mind.
Okay, I'll keep going. I'll try and speed up a little bit, but I like the questions. So, like me talking about universal life. It's similar to whole life, but rather than having to pay some fixed amount every quarter, every month, or every year, let's say you just came into a large windfall and you want to just pay once and then have that carry the coverage for your whole life. The main theory with universal life is it's flexible. So similar to a whole life policy. It doesn't really come to an end. And it builds up a value for the most part. And you can withdraw on that, you can take loans out, and then it can get quite complicated, which I'm going to try not to get into, with various types of guarantees and changes in interest rates. But I would say it's very similar to a whole life policy, other than you can, as the policy holder, you can put in premium in lumpy amounts. So let's see if did I miss anything on here? If the cash value falls below zero, the coverage ends. So there's basically an account that you put money into, and then we deduct charges from. And if that account goes below zero, that's what kind of makes it the coverage end. And similar to term, there's a whole host of riders and ancillary benefits that that you can tack on to universal life. So as an actuary, universal life is quite interesting. So that flexible nature of it is what makes it interesting from an assumptions perspective, because we have to come up with assumptions on when the premium is going to pay and what the interest rates are going to do, and in addition to the mortality. So unlike term, where we kind of know what the premium is going to be because they're not allowed to pay more or less, they can only pay the billed amount. This flexible part makes it quite interesting. So, any questions on universal life?
I have a question. When you're talking about having to, come up with these assumptions and whatnot, are y'all doing that primarily to build models that somebody on the front end is able to apply to anybody that comes up, or do y'all have to ever do it on like an individual basis?
It's a good question. Probably all of the above. So on an individual basis, so just in the sales process, we need to show the policyholder, well, if you paid, if you paid this way, this is how your account value would evolve. And if you paid this way and interest rates do that, this is how your account value will evolve. So that's like an upfront individual application. Then kind of in one of the previous slides, we mentioned like valuation. So to come up with how much reserves to set, we kind of also need an assumption for when the premium is going to come in, such that that money is available for us to invest. I might be getting too into the weeds. So basically, it's a long way of saying we need to come up with an assumption for the premium to come up with a good reserve amount for accurate financials and being able to pay the claims. So did I miss an aspect of the question? Or?
No, I think that covers it.
So maybe I'll try to say it slightly differently than Brett said it. Not that his answer was right off, but maybe to tie in. So the upfront sale, you go to someone and you sell them a policy, and they tell you that this is the amount of premium that they want to pay. This is how they expect to take withdrawals from their cash value in the future. But in reality, that's not necessarily what happens in the life of the policy, right? And so we have to make assumptions for our valuation about what really like what policyholder behavior may end up looking like. And so the assumptions that we use for our own valuation modeling might be different than the assumptions that are built into the sales, kind of projection that we give to the policyholder, if that's helpful. And our assumptions are based on what we see in the broader block of policies. So we've sold 1 million policies, and we can say, okay, more than likely 85% of the people are going to pay their premium as expected, and 15% are going to do something else, that kind of thing.
And this is interest accruing for the policy holder?
So once they kind of put the money into the universal life contract, then they get credited interest similar to a bank account. And that's on the plus side to the policyholder. And then on the minus side, we kind of take out amounts to cover the insurance that they're getting. So if you think about it like a term policy, whatever we would have charged for like a 1 year of term coverage, we would take that out of the account value. So we giveth interest, and then we taketh away the insurance amounts. So does that help?
Yes.
Did I miss any? So emphasize the most flexible type of coverage. It's kind of straddling you could think of insurance as having a spectrum of protection, which term is like a very protection oriented on that spectrum, and savings, and universal life is kind of in the middle. So here's the not 2020's life insurance results, but 2017, 18, and 19. So as I previously mentioned, we did make money pre-pandemic. So we collect premiums, we charge, that's the money for term and whole life policies that customers have paid. Like I was just alluding to, we take money out of universal life policies to kind of cover insurance. That's this policy fees. With the money we already have, we've bought in bonds and stocks and stuff, and we get investment income off of that and some other income. But then we've got to pay benefits, which is the biggest number on the minus side. We have to credit interest, Christy, as you alluded to. There's this kind of a not real straightforward concept of deferred acquisition costs, which is a ton of work for actuaries. So if we pay a sales guy $100 in commissions, that's not an expense of $100 today. We get to kind of take that over a period of time. But so this 115 here is us we parted with the cash a long time ago that we gave to the sales guy, but we recognize it in expenses over many, many years. So that's what that 115 is basically doing. And then some smaller numbers here, but keeping the lights on, paying the actuaries, paying the CEO, that's in this general operating expense. So biggest one, which we like to see, is paying the benefits. So that's the biggest on the expense line. Paying the expenses is the second biggest, and interest to policies is the third, and then some smaller items. So that's kind of a, and I'll just note that actuaries have a lot of input on these lines. So a lot of models are used to make projections on these amortization of deferred policy acquisition costs. And on the reserve side, you know, lots of complicated models need to be built, maintained to calculate those. So I don't know, any questions on? This is called an income statement, by the way.
I have a question in maybe this area. So I believe when you said that when you take in policy premiums, that a certain portion of that money has to be set aside kind of in reserve, for the event that you pay out. And I imagine that there are like legal requirements related to this, and not only just like prudent business decisions, but I imagine there's like certain legal framework for that. And along those lines, are there, if you've got money sitting around, I assume you can collect insurance on that like any other money sitting around to some degree, because you mentioned that before. So are there limitations to the type of financial instrument that you can sort of have that tied up in? Like, is it only bank accounts, or could it be like at the whims of fate to some degree, like where you are with that money, or it has to be like in a completely sort of shoebox type position, I guess is the question.
Great question. So first one I think was, are there laws around the reserves? So the short answer is yes. Like the insurance departments kind of have some rules on the minimum amounts of reserves we need to hold on a statutory. So I'm not going to get into this big distinction, but suffice to say, hopefully there are rules for the minimum amounts of reserves we need to hold. Then on the investment side, I don't know if we're not allowed to invest in certain things, but we need to hold certain amounts of capital based on the riskiness or the credit rating of investments. So if you want to invest in AAA, I don't even know if the US is AAA anymore. If you want to invest in US government bonds, that's generally considered low risk, and you don't have to hold as much capital. And if you wanted to invest in GameStop or something, you'd probably have to hold a lot of capital against that type of investment. But the earnings from those is coming through this net investment income line. So that's a big portion of the total income. So I don't know, it's like a third, just eyeballing it. It's not exactly that much, but investment income is a big piece of the picture. Did I miss a portion of the question?
No, I don't believe so. Thank you.
All right. Sorry about my guest here. Life insurance basics, actuarial aspects. So so these are like the stuff actuaries spend a lot of their time thinking about and working on. So the pricing exercise, what premium should we charge for a UL policy, universal life, or VUL, variable universal life? Didn't really touch on that feature much, but that kind of takes a mutual fund and layers it onto a universal life policy. How should we underwrite? How's the experience coming through? Of the premium that we've decided to charge, which is kind of the pricing exercise. How much needs to be set up reserves for benefits, expenses. So 2 years ago, it wasn't on the forefront of many people's minds that catastrophes happen, and but now it kind of is. And for actuaries, James, I think you mentioned the Spanish flu, so we kind of used that in previous models of pandemics and stuff as the how bad can things get in a 1 in 100 or 1 in 200 year scenario. So now we've got another interesting data point to look at in the future. So we got to think about that when we're coming up with reserves or premium. And how do we think about the experience? I was probably on a call right before this one, thinking about how do we look at our experience over the past year, given that, we probably don't expect that to repeat in the future. So these are the things that if you find to be, oh, I skipped something. What would it take for our company to go under? So that's another question that we concern ourselves with. We obviously don't want our company to go under because we have a duty to the policyholders to kind of pay what we've promised to pay. So multi-dimensional kind of problem to solve and optimize. So hopefully I painted the actuarial profession in some sort of a positive light here. Any questions? I think that's the end of the prepared materials here. Did Doug ever appear?
Doesn't look like he was able to join.
That is unfortunate.
Yeah, but great that you were able to talk through this anyway, Brett. Great job. Thanks for talking through it.
Thank you.
Yes.
Any other questions?
I have a question.
Sure.
Obviously last year was the COVID outbreak, but how closely do y'all monitor health trends and viruses? And in the case of COVID, it's a virus. There's going to be antigenic shift and drift. Like it's going to change. How on top do y'all stay of like viruses, spreading of all kinds of things? How do you forecast for that?
Other than being aware that pandemics happen at some frequency and some unknown severity, like our finger on the pulse of the virology of the time is not something really on my radar. Maybe Doug would have a different answer to that. So it really just, in my world, became a topic in March of last year, other than knowing that the Spanish flu happened, highly suspecting something will happen again because history tends to repeat itself. So short answer is it wasn't really on the radar.
Well, okay, like a couple years ago, we had Ebola in Texas. I guess my question is, how closely do you monitor things globally?
So let me just add to what Brett said. So I think maybe actuaries were not paying attention to pandemics and those kinds of things. We do have there's a couple of groups within AIG that pay attention to those kinds of things. And actually there are actuaries in one of them. So our enterprise risk management group is kind of charged with, they monitor things like pandemics and the risk of these catastrophic events, and kind of inform our, like, AIG senior management. The life business actuaries don't necessarily pay attention to those kinds of things, but our enterprise risk management folks would keep us informed, you know, and are kind of charged with calculating the amount of capital that we need to hold for these very, you know, kind of one-off catastrophic events. The other thing is there is, so we also have a chief medical officer within the AIG that kind of advises on a lot of you know, medical developments and health trends and that kind of thing, and that informs our underwriting. So I'm on a call every couple of weeks with we call it the Life Sciences Working Group, with the chief medical officer and a lot of our underwriters, where they discuss, you know, in some cases, trends that are happening with health and medicine and that kind of thing. So it exists. It may not be one of the concerns of the life business actuary primarily, but we certainly monitor it.
Thanks for. I was narrowly answering from my perspective, so thanks for the broader perspective, Brandon.
Thank you. That's something I'm interested in. I think that's fascinating.
Yeah, consider just look up enterprise risk management for. I mean, it's an actuarial kind of specialty, and they focus on those kinds of things.
So on a similar direction, what about global conflicts and how that potentially plays a role in it, from like a kind of ho-hum way, or even, you know, so I mean, I was thinking with the Spanish flu, I believe that primarily affected young people who are, I would imagine by and large, are less likely to be purchasers of life insurance. So that maybe like would mitigate somewhat the damage in that regard. Whereas an event like World War II, where, you know, some insane number of people died, that is enormous. But what about, I mean, or even like, I imagine them, I mean, we kind of get into silly areas, but like suppose alien invasion, right? Like, is there like a government, are there legal frameworks for sort of clauses, sci-fi clauses, where some existential threat that actually like would involve people of all ages being drafted into the conflict, or even, you know, a modern day Genghis Khan of something like that, that is a widespread, you know, huge calamity type event. Is there some kind of government like framework that would like limit your risk in such a circumstances, or does that always have to be somewhere in the back of your mind?
So I'll comment similar to what I said before, on like our enterprise risk management actuary. So when the COVID pandemic first kind of began, we have an area that does our experience studies, that develops like our view, helps us develop our view of what mortality will look like over the next, you know, however many years. I saw a report, and again, this is kind of outside of our, like, Brett and I's scope, but a report came from the Enterprise Risk Management Group, informed by our experience studies group, that had a whole list of, you know, just catastrophic type events. I don't think they had like alien invasion on there, but they certainly had like governmental type, you know, occurrences. They had all kinds, you know, everything from Spanish flu historically, and all of the historical events that you can think of that happened. All of those things kind of fed into their model. And they used that to, like for COVID, they used that to kind of calibrate the potential, you know, future impacts of COVID. And so there certainly are models that exist within AIG, and we have like a company's view of like, and you know, I guess you would call it like futurism, and you know, all of the potential futures that could possibly occur from here until the end of time. And there's a view that feeds into, I think what ultimately impacts AIG is in our financials is the amount of capital that we hold. And so while those events are probably really, really remote, like they don't necessarily move the needle on the amount of capital that we hold, but they are, we do have a pretty exhaustive listing of all the possible future, types of events that could impact our financials. And there are people that model it. They're just a bit removed. It's done more at so AIG, Brett and I are within the life insurance business. It's done more at the AIG global corporate level. And so we don't necessarily get to see it as much, as frequently.
Okay, if no one else has a question, I have a couple more.
I have a couple more.
Okay, well, you take precedence. So Brandon knows I've got plenty of questions to I typically have a few.
Well, you opened the floodbanks, and now I'm like, well, what about terrorism and things like that?
When you ask
No,
these questions, are they from like a life insurance perspective or from like a property casualty or both?
Oh, I guess, well, you all would know more about life insurance, right? I suppose. But, or like,
On the property casualty, minimal exposure as a warning that I've had. There are typically like exclusions for terrorism and those other types of very high severity type events.
Asteroid.
Again, the aliens and the asteroids I haven't come across all too often, but
I mean, it does happen.
the asteroids do happen, yes. I don't know about the aliens. So.
No, that as of yet, I think is not happened.
But life insurance policy, if you die, here's my understanding, not as a lawyer, any cause of death, terrorism, unless you died after lying on your application within the first 2 years of it, you have a viable claim. So,
well, I'm also, so in this direction, I normally had not thought about it in this way, but do you think that it changes working in this field? Does it change the way that you perceive certain like types of entertainment? Like when you watch Independence Day, do you go, oh, the payouts?
or where you travel to?
Yeah.
I did a lot of traveling out of the country during the COVID pandemic, and my mom was not very happy about it. And so I don't know, maybe it doesn't impact the way you think that much. But also, similarly, like I do feel like I'm a little bit more informed about real statistics about COVID and that kind of thing and vaccination, because we actually do monitor that stuff pretty closely, especially with COVID. Like I said, that call that I'm on every couple of weeks, we get kind of up-to-date statistics on like the U.S. population that are probably not as readily available to the public, and on our insured population that may, recently have, probably before the public felt as comfortable as they did, made me feel a little bit more comfortable about the direction that we were heading, because we were watching the trends of deaths and hospitalization in certain states really closely, and we would get updates, like daily on that kind of thing. So.
Just to respond to your question, James, me personally, I was kind of always, not the most aggressive person, and I continue to not be a super risk taker. So the industry, I don't think has affected me much.
My wife works for the county in COVID dealings, so that has certainly affected our thought process behind various gatherings and things of this nature.
That's fair.
Can I ask another question on accidental death? You talked about accidental death clauses. The rationale behind that, maybe you could shed some, I mean, it made me think about why, from the beneficiary point of view, that would seem to be one of the least expensive ways for a family to have a family member die, and yet it pays out larger. It would seem that you would prefer a larger payout on something that, long-term illness that is, in our society at least, a very expensive way to die, rather than in an accidental death kind of framework.
And on the other side of that question too, if you're in, say, you die in a car accident and it's the other person's fault, don't you get to make a claim against their liability insurance or your family? I mean, how does that work? Do the insurance companies fight each other over that?
Okay, so the second part, I don't feel like I'm overly qualified to answer other than as a car insurance customer. But that's like the personal liability aspect. The accidental death, I'm going to take a shot at it. So from a societal utility perspective, James, I think I tend to agree with you. However, it's we've already got a person sitting down that wants to buy insurance. So it's like a little ancillary add-on, I would say, that we can kind of charge them for, that it tends to be a profitable add-on, and it sounds good. I think that's kind of
a marketing thing more than anything else.
Right.
Or sales. Okay, that makes some sense.
No, because your intuition makes a lot of sense, but covering those acquisition costs is a big part of just the business of life insurance. So once you've got the person sitting down, any marginal dollar you can increase, just like the the impulse item at the grocery store, is kind of high margin. And then
it's really I hadn't thought about like the relative cost of a death from an accident, which happens really quickly, versus an extended illness or something. Interesting point.
I don't want to dismiss the second part, Christy, that you asked. So could you say that again? Maybe I'll have a different thought.
Well, I guess what I'm saying is the beneficiaries of somebody who dies in an accident where someone was at fault.
Mm-hmm.
I guess what I'm saying is, can they make claims on both your policy and against? It's a technicality. I bet you can.
Oh, so in the event of a lawsuit, can I see what you're saying. I don't feel
some of your payout if somebody else was at fault based on their insurance.
Yeah, is it like an NBA contract where when you get cut, if you sign in with another team and they like pay you more than that, then the first team isn't on the hook for the same amount of money?
I'm imagining it's like, who owns that benefit, and are they a party to this lawsuit, is what I'm imagining it will be the case. So if the estate was some beneficiary and the estate owned the car that killed someone, I could see that possibly being in the pool of assets to start taking. Again, I can imagine lawyers arguing for a long period of time on this.
I do have a question for Brandon. Since you're in Houston, yeah?
That's correct, yep.
When you go into the office, do you go to the AIG building on Allen Parkway?
Yep, that's the one. Yeah.
Just curious.
Yeah. No, it's a cool office and a cool place to work. Great location. I haven't been there in over a year now, but that's the one.
Yeah, if you can't tell, we're working at home.
What about smart contracts? Does AIG, do you have internal discussions in this direction of, you know, I mean, it's very popular article to write about how it's revolutionizing the insurance game, but is that something blockchain related, smart contracts? Is that anything that AIG is internally, or are you in this business already? Do you anticipate something in that direction? And then how would that like sort of change your role when you've got something so new, or maybe it isn't new in terms of your roles?
I
am not familiar with smart contracts.
I'm not either, actually. I'm not familiar with that term.
My understanding, I mean, my blockchain knowledge is very limited, as my financial holdings would tell you. But it's, you know, my understanding is that like because of the open source nature of like the ledgers that, you know, have to do with the blockchain, right? Because like the blockchain itself and the mining, I believe, encodes all the transactions, and then there are like other aspects of society or somehow that are like encoded in this. And my understanding is that these are like insurance contracts, I imagine, like related to like cash flows potentially for businesses or other kind of big picture events. And in the way that they're like payout, where the insurance contract pays out based on something that is like viewable to all, rather than a person having to file a claim on it, is my very basic outsider understanding of what smart contracts sort of the picture is for the, like, it's like one of the things they point to like long-term utility for things like Ethereum and whatnot.
I would venture to say, you know, we are AIG, when I say we, is active in like cyber insurance and stuff. So not our department, but I do think we are a market leader in that. So a little plug there, as my ignorance shows. The life business, I don't think has gotten into that.
Yeah, I don't know how the blockchain would know who died and not, but that's anyway.
Interesting concept. I would be interested to hear about it too. Well, if I hear that terminology and you know, we have like company-wide presentations and stuff. If I hear that, then I'll try to find somebody to come and talk to you all the next time about that stuff. But I'm not familiar. I haven't touched it yet.
It may be a pipe dream at this point, kind of more of a long-term idea.
Yeah, internally, Brandon, maybe someone from ERM probably would have good perspective that this group, I'm thinking, would be quite interested in hearing.
Good point. Yeah. Okay. Looks like, Brett, you probably need to send to your family. And I think you all probably have content that you all were going to get to for the rest of the evening. So not to cut off questions, but if you all have other questions that you want to ask to us, I'm always available to answer emails or talk on the phone. Feel free to reach out to me on LinkedIn. I imagine Brett would say the same thing. We really enjoy coming and talking to you all. So thanks for the opportunity to come and share with you all again.
Yeah.
Yes. You probably saw Ty had to leave, so I will be in charge of telling you thank you very much once again. We always appreciate your insight and, I guess in my personal case, patience with questions and things. So but thank you very much.
Thank you. This was fun and informative.
Thank you. Yes, thank you so
Thanks,
much.
Great. Yeah. Reach out to me also. So if you want to.
Take care.
Thanks. Bye-bye.
All right. Take care. Bye.
Okay. Happy solving, people. Bye. Mohammed, are you in charge today?
Yes. we
Okay,
have
so you're
continue
ready to take over?
7. Yeah, thank
Okay, bye guys. Have fun.
you. Bye. Yeah, just share the quiz in the Google Drive. Can you please look at the quiz? I guess we can. You can think about that until, I don't know, 30 minutes or something like that. And then if you have time, I will go over the questions and solve them. So the quiz is in session 3 folder in second half Google Drive.